Welcome, everyone, to today's Explainer. We're diving into something that is absolutely fundamental to the economic health of one of the world's largest economies. You know, we hear it all the time. Rural India is the great economic engine of the country. But just like any massive, powerful engine, it needs the right kind of fuel to run effectively. When we're talking about agriculture and rural development, that vital fuel is, without a doubt, credit. Why? Because for the vast majority of rural families, everyday savings just aren't enough to finance modern farming. So today, we're going to unpack this fascinating, complex ecosystem of agricultural credit that literally keeps this engine running.
Okay, to really grasp why this matters, let's look at the numbers. Based on the 2011 census data, you can see the sheer scale of what we're talking about. A massive 68.8% of the population, that is over 830 million people, live in rural areas. Think about that for a second. When we discuss economic growth, poverty alleviation, or just raising the standard of living, it is mathematically impossible to hit those goals with a rock-solid strategy for rural development. And as we'll see today, getting financial tools into the hands of small-scale farmers and the rural poor is step number one.
So here is our roadmap for today's Explainer. First, we'll look at the core rural credit problem. Then we'll break down short-term cooperatives, followed by long-term cooperatives. After that, we'll check out the role of commercial and regional banks, and finally, we'll wrap things up with the microfinance alternative.
All right, let's jump straight into part one, the rural credit problem and why getting institutional finance out there is such a desperate need.
For the longest time, farmers have had to lean heavily on what we call non-institutional sources of finance. And honestly, it's wild, but these sources still make up about 40% of total rural credit in India today. We're talking about local moneylenders, traders, and commission agents. The problem here is huge. These lenders are notorious for charging massive, predatory interest rates, and they usually demand that farmers mortgage their land or assets as collateral. Without proper, formal banking channels, farmers just get trapped in this vicious cycle of debt. This makes the progressive institutionalization of credit, basically getting farmers into a formal banking system, an absolute necessity.
Moving right along to our second stop, short-term cooperative credit, which is all about funding the daily grind. Farming is definitely not a cheap gig day to day. You've got expenses popping up constantly. That's exactly where short-term credit comes in. We're talking about loans that do not exceed a 2-year time frame. Think of this as the fast-burning financial fuel for your everyday farming supplies. Cultivators rely on these loans for immediate necessities, stuff like fertilizers, high-yielding variety, or HYV seeds, and just keeping the livestock fed. It basically covers the immediate costs needed to get the current crop in the ground and successfully harvested. So how does this short-term money actually reach the farmers? Well, it relies on a pretty incredible 3-tier grassroots structure. It's designed to flow from the top down to guarantee local access. At the very top tier, you have the state cooperative banks, or SCBs. They funnel resources down to the middle tier, the district central cooperative banks, or DCCBs. And finally, those district banks supply the third tier, the primary agricultural credit societies, known as PACs, which operate right there at the village level. It's a highly structured, interconnected chain built to pass short-term credit directly into the farmer's hands.
Okay, on to part 3, long-term cooperative credit. This is where we look at funding the really big purchases.
Now, contrast that short-term stuff with long-term credit. Here we're talking about loans that stretch out for a period of more than 5 years. Because let's be real, you don't need a 5-year loan to buy a bag of seeds, right? But you absolutely need one if you're buying heavy machinery, like a tractor. Long-term credit is strictly reserved for massive, productive investments. We're talking buying large agricultural equipment, purchasing new plots of land, or making permanent, lasting improvements to the land itself, like digging complex irrigation canals.
To manage these massive long-term loans, the cooperatives operate on a specialized 2-tier structure. So unlike the 3 tiers we just saw for short-term needs, this is just 2 levels. On one level, you have the primary cooperative agriculture and rural development banks. These operate at the village level as totally independent units. On the other level, you have the state cooperative agriculture and rural development banks. These operate from the state level, but they push their services out through branches located across different villages. Both levels share the same goal, meeting the heavy, long-term credit requirements of the farmers.
Next up, Section 4. Let's look at commercial and regional banks and how they essentially bring Wall Street to the village. Now, cooperatives are amazing, for sure, but traditional commercial banks play a massive role in this ecosystem too, and their strategy is actually pretty straightforward but incredibly vital: physical expansion. By deliberately establishing physical brick-and-mortar branches directly in rural areas, these commercial banks bring formal, highly regulated institutional credit right to the doorstep of rural communities. It provides a much-needed, safe alternative to that local moneylender we talked about earlier.
But here is where things get really interesting. Enter the Regional Rural Banks, or RRBs. Specially established under the RRB Act of 1976, these banks exist specifically to cater to the needs of the rural poor. They are basically the perfect hybrid institution. They were set up as rural-oriented commercial banks, meaning they have the low-cost profile and local touch of a cooperative, but they operate with the professional discipline and modern outlook of a commercial bank. It's totally the best of both worlds, aimed directly at rural upliftment.
Finally, we arrive at our last section, the microfinance alternative, which acts as the ultimate safety net.
We gotta stop and ask a really crucial question here. If institutions like commercial banks and RRBs are offering specialized, concessional, meaning cheaper, interest rates for rural credit, why don't small and marginal farmers just easily use them? It seems like a foolproof solution on paper, right? But as we all know, good intentions and cheap rates on a corporate brochure definitely do not automatically translate to easy access for a struggling rural cultivator.
The harsh reality is that there is a massive gap between theory and practice. Real-world barriers keep many small farmers completely locked out of the system. The source material points out that these farmers face borrower-unfriendly products and incredibly rigid, complex procedures. There's zero flexibility and constant, frustrating administrative delays. On top of that, the transaction costs to even secure these loans are incredibly high, and tragically, that includes both legitimate bank fees and illegal costs, like bribes. For a poor farmer, these hurdles make getting formal bank credit almost impossible.
And this is exactly where microfinance institutions, or MFIs, step in as the ultimate safety net. Recognizing that traditional banks were accidentally leaving the smallest farmers behind, non-government organizations, NGOs, started stepping up. Since the mid-1970s, these MFIs have provided alternative means to enhance credit access for the poor. They entirely bypass the rigid bureaucracy of traditional banks, offering highly flexible, accessible microloans directly into the hands of the people who need them the absolute most. So as we wrap up this explainer, it's pretty clear that fueling this rural engine takes an incredibly intricate, multi-layered web of finance. We've got everything from those three-tier short-term co-ops to specialized rural commercial banks, all the way down to agile microfinance NGOs. But having the institutions just isn't enough. The access has to be real. I want to leave you with this provocative thought today. As India's economy continues to modernize at breakneck speed, how must these financial institutions adapt their procedures to ensure that the friction of borrowing is totally eliminated and truly no farmer is left behind? Because ultimately, rural development is the absolute prerequisite for the nation's true economic growth. Thanks for joining me on this deep dive, and keep questioning how the systems around us actually work.